The ASX and Dow Jones have exceeded their mid-August highs, which is a positive sign. The test in these whipsawing volatile markets is to get both the sector and stock selections right from here. Gary Glover from Novus Capital has navigated us through 2022 with a stellar record and is now giving us an update for this week. Good morning, Gary. How are you?
Yeah, I'm great, Chris. Yeah, it's a great call, actually. That's exactly, I reckon you're spot on there. I think we can still make money here, but some sectors are going to struggle here. Even if the market does have a pullback there, which I think is sort of likely here from December, I think there'll be sectors that go up. So, yeah, like we've seen here, even through sort of the bearish phase, we've seen plenty of sectors go up, even though it's been in the bearish sector. So just got to be, got to be very sector and stock specific here, I think, from now on. Probably got to start lightening off here, I think, into the strength. That's kind of obvious to me. So we want to lighten off a little bit, but some of the stocks are still looking okay here and can push on here. Even if the market does start to sort of congest or we'll start to go through a bit of a correction phase. Yeah, I think even the first sort of month of that, you might find that a lot of stocks can still sort of go up in the face of that sort of congestion. So stock selection will be very important.
If we think back to just a couple of months ago, both in October and in June, you were picking out companies that were in leading groups, leading companies, and specifically in October, you were identifying companies that had higher highs while the market was retesting those June lows. And I guess that's testament to the fact that you're looking for that strength, and that's where this portfolio that we're looking at on the screen now, a lot of that outperformance that you've got here, has that come from those companies that were already showing strength into the October lows?
Yeah, some of them were. Yeah, I think just trying to pick some of the stronger ones, trying to pick some of the obvious candidates, trying to pick the right sectors, which it'll, and then to be honest with you, I think I sort of probably got I was thinking that growth might have been a little stronger than it was. So once I realized that it wasn't, then I just had to pivot a little bit and be a bit more value orientated. So again, good traders have got to recognize when they get it wrong and then make some adjustments. So, you never get it right all the time. But as long as you can sort of pivot and move correctly, that's the way to go here. So, I sort of initially I thought some of the growth might have, some of the growth stocks have actually done pretty well. I mean, things like SIQ and Domino's stuff they've done pretty well, but definitely been a few in that area that have struggled a bit, and some of the value shares have been just as impressive, if not more impressive. So that's sort of been the only sort of shift in there. So but not too bad, I think. So we've had a pretty good run here now. Portfolio's up pretty nicely. So next week or two here we'll be trying to take some off here. So, look, as I said, so here we're 22% up in the first 5 months of this year. That's a cracking move for the market. So, that's beyond what I've returned in the last, each previous year in the last few years. So, we've had a pretty good year so far. But so you got to bank some of that here. That's imperative. So, yeah.
Well, that's probably a good point to, as we're edging into December in a pretty heavily fully invested portfolio, 94% of the report now says it's invested. When you're coming into December, how are you trading these stops? Are you sort of tightening them to try and get out? Are you lowering profit targets where they're fatiguing? A bit of both? What's happening?
Yeah. So I've reeled in sort of some of the targets, and I've moved up some of my stops as well. So I've sort of tried to tighten up here. So, that's exactly right. So, doing it across the portfolio. So just, trying to take off maybe some of the high beta stuff. So, things like the LNAS and the GGUS. Obviously the GGUS was the one that really performed pretty well. Wish I'd just left the LNAS out and bought more GGUS, but that's all right. But then, just other stocks have had pretty good moves as well. Here's some sort of high beta sort of stuffs there. So just take that off first here. So, still think the market can push on a little bit high here, Chris. I know we've had a bit of a pullback here last night, but I still think we can sort of run up into the early December there. There's sort of we haven't had too many down days actually, really. So yeah, so we are due for a few. These should get a few little pullbacks as you approach the top as well. So should start to see a few down days as you get close to that high. Should get a bit more volatile as we approach a bit of a peak here. So, but yeah, just gonna start. It's gonna start. Yeah, just start trimming a little bit here into strength there. So, but don't be surprised if this sort of does push on a little bit higher than everyone thinks. It's sort of definitely markets have got a history of doing that. So, as we'll show in some of the charts here ahead here.
Well, that's a good point that you say history, because those stats that you're talking about, obviously they're coming from historical references, and you've got a good one from 20 years ago on the NASDAQ. But before we have a look at that history lesson, let's just have a quick check-in on the NASDAQ. You've said for some time now it's underperforming. Like you said, you've repositioned your portfolio away from growth where you thought there could be good recovery to when it didn't show that strength. You repositioned and went elsewhere. Are we still, this is still a laggard? Is there much else there other than this kind of target region you've got on the chart there?
Yeah, look, around that 50% level has been sort of struggling to push above so far. So that's definitely been some resistance there. I still do like the chances of sort of getting back up to that higher range there. I mean, that, to be honest, that's going to suit the bear sort of story, is if it goes up to the top of the range and then turns down there, because that'll get the bears excited if it stays under that channel line there. That's what we want. We want the bears excited on the way back down again here, because we got to trap them like we did last in October here as well. So interesting thing is, obviously we've been talking about NASDAQ underperforming, which has been a bit of a concern, and obviously high inflation environment does underperform here. But as we sort of show in a couple of charts here, that underperformance actually is not a bad. It's actually more positive than you might think here. So yeah.
Well,
we're going to go straight. We'll go.
Well, do you want to go straight to it?
Yeah, let's go straight there. Then we can come back. Yeah. So I mean, so I was looking at 2000 to 2003. That's sort of like the last sort of corrective period, the last sort of growth crunch there. And if we go back and look at, I mean, that was a big. I think it was like 78% down on the NASDAQ. I think it was 50% down on the S&P, and about 38% down on the Dow. So that sort of gives you, growth gets hammered a bit more. Mid cap sort of, not so much, and then the Dow, the leaders sort of hold up better, and that's sort of typical of those sort of growth crunches there. But looking at how the market sort of came out of the low. So if we go back to October 02, which is again another midterm year, October period as well. It was pretty dull bounce coming out of that, which is the green line there, the green box there, Chris. That was probably more sort of dull period there. Whereas on the way down, all our bear market rallies were all short and pretty sharp. Most of them were pretty quick. Most of them within a few weeks, might have been, 3 to 6 weeks there. So it wasn't, whereas you're sort of getting a bit more of a controlled sort of rally here. That was probably the second last rally was a bit more controlled, but the actual, the first move up here was actually sort of timid here. So not impulsive in nature. And then we got a bit of a correction, we've got a bit of a corrective period as well here. So we almost sort of got more of a base build occurring there, which is probably happens after you do sort of go through a bit of a damaging period, which obviously this was. So the fact that the first leg up out of that bearish phase in the past there was more like a base build and more of a corrective sort of setup there is actually probably quite positive there, because that's sort of that's how this market, the rally at the moment, looks like as well. It's more of a corrective type of setup here. So, and that's probably quite normal to actually sort of start building here. Whereas if we'd seen something really impulsive, a quick bounce in some of those growth stocks, that's probably more resonant, of a bear market rally. This is, if we, because I sort of think the October low, these midterm years is where the big lows come in. And I think the Dow actually breaking above the previous high does sort of rule out a lot of those really bearish sort of arguments, sort of the fact that the Dow has now has gone above the previous August high. Also, XJO has also gone above that previous high as well. That sort of rules out for me. That rules out, the more bearish scenario of actually sort of being just a bear market rally here. So I think it's pretty constructive. So I actually think the low is in here October. I think the next sort of pullback here, whether that's into sort of something like a February or March, whatever it ends up being there, that's just going to be the first high low here. So I'm looking for a bit of a messy sort of corrective pattern off this sort of next peak here. So sometime in the next fortnight there, we might sort of see a peak. Then I think we'll see a bit of a corrective period for maybe the first month, and then maybe sort of something slightly deeper in the second month. But then that should sort of be setting up our first high low, and then hopefully by that stage, if the inflation sort of genie is starting to sort of cool off, then I think equity markets can really get going into next year. If the inflation does hang around, then we can still have a rally there, but it's probably going to be more of a up and down corrective sort of sideways rally here, which has been typical in those sort of 40s and 70s. So look, either way, I think it's sort of constructive, sort of positive. But if we really see the that inflation can drop off by by sort of February or March next year, that'll get the market pumped up here. So but yeah, could play the long game here. But yeah, it should be pretty interesting sort of setup here. So I guess the main thing there's two things here, sort of getting close to a bit of a peak here. I think we can push on sort of slightly higher. We've seen here in that in the past there with that 2002 period. I think we sort of on that chart there, Chris, on the XJO. If you go to that,
Let me see.
I think it's on the third page there, sort of the one that sort of shows how the XJO traded. Yeah. So this is the thing you got to remember too. So like, if you look at when the NASDAQ sort of topped there, that was sort of obviously early 2000. The US market went into a pretty decent decline there, and all the US indices made lower highs from that point. Whereas our market expanded to a new high and pulled back, expanded to a new high, pulled back big, expanded to a new high again, then pulled back bigger, and then actually ended up going slightly lower there. So it did not sort of
Didn't conform.
Didn't conform to the US. It ran its own race. There's different things going on. So this is the thing here with sort of markets here, is a lot of them are running. There's different races getting run here within all these indices. That's why I think you can still make money here, even though the market might go through a bit of a corrective phase. There has been segments that have been going up and going up strong in the face of a sort of negative or declining market here. So that's why I think sort of stock specific sort of stuff here is going to be really important. It's going to be really important to be in the right right sectors here. So I think this is be some big moves. That's the thing about these sort of more volatile after these corrective phases. You get some bigger moves, you get some bigger ranges there. But yeah, you just got to be careful there. Just can't fall into the trap of sort of falling in love with the most, once the crowded trades in, you got to be out. So, and then once the trade's unloved, they're the ones going to be watching, So I think it's going to be really, really volatile ahead here. So, fascinating period. That's a really good chart there. Just so it sort of shows you that just don't lock into a certain, to a view that everything's going to fall, replicate and follow each other. You're already seeing here the Dow's way outperform growth, so different sectors are going to move. There's been plenty of sectors that have gone straight up here in the face of markets that have been going down as well. So I think you're just going to see some really big sort of sector by sector moves here, even some of the stocks as well. So it's
This is a great chart. If we just cast the net for 12 months and we go for the top here, so as you said, sort of that's the March, April.
Yeah.
If we look out March, April, the market didn't go anywhere for that 12-month period from a net perspective. But if you look, as you said, 11.4% drop, 16.7% rally, down 6, up 6, down 6, up 6, down 6, and then it's back to evens. So like you're saying, if you're trading that market, there's a huge amount of opportunity there. If you're an investor, you've picked up a divvy and had a lot of emotional pain throughout it. And then casting that net once again, we just push it down here. You've got, looking into these two sides, you've got 11% rally, 17% drop, and a 21% rally, back to another decline. So whether we have this market to the first year or the second year, either way, the market ended up net zero, but you're still saying there's a lot of trading opportunities in those markets, isn't there?
Oh, yeah, no, heaps. It'll be fantastic, actually. Like the 30-30 report we run on Fridays, Chris, that should sort of, should start to sort of show which sectors will sort of start moving and then which ones should run. And they should run for a while. They shouldn't just be for a week or two. They should, you'll get sectors which will run for, 4, 6, 8 weeks and stuff there. So there'll be some decent moves there. So you've seen, some pretty big moves there. And if you look through the sectors all have big moves up and down as well. You've seen the sort of stocks there. Just look at a chart of CBA, which is, with the front line number one bank, have a look at that chart for the last probably 12 to 18 months there. It's gone up and down, up and down, up and down. You can probably draw your ranges and stuff and just sort of sit in the middle there. It's had some big swings there. It is getting way overvalued, then getting undervalued, and then getting way overvalued, then getting undervalued. It is not just sort of trading steadily and in a sort of in a mild
It's not treading
manner.
water.
It's trading quite violently into some big swings there. So yeah, I mean, look, if you're an options guy, I do a lot of options as well, Chris, with I have a lot of options clients over the years because that's sort of my background. So it's a perfect covered call writing market here. Perfect, to be writing puts on, writing covered put stuff that you want to buy and stuff there. But it's sort of, it's going to be a really volatile period. So the premiums are, obviously higher in that period as well. So that's a strategy that was going to thrive in this sort of market here, I think. So it's pretty interesting.
Well, that's probably a good point to move into your trading shares for this week, because you're picking out some names, talking about volatility and opportunity. Healius is one you've had on the short list for quite a while now. You've been watching this pullback. Now, the candle that you've got on here for the weekly chart, it's undercutting this low, and it looks pretty positive, closing up near its highs. Is that a pattern that you look for regularly?
Yeah, look, I like the level here because it's sort of sitting on top of the previous high. So I thought it was a bit of an area of support to sort of keep an eye on there. And then so it actually cut through my stop there last week. So actually I basically sort of knocked out half of my position and then just remained and held the other half there just because it's sort of I like this sector here. I still think the healthcare sector, and we're seeing here with Ramsay's moved higher and Sonic's moved higher, so the other stocks I've sort of got in portfolios as well. So I do like this sector here. It's just been, market's been a little volatile there. But I like to look at this here. But I can see here the last couple of days, it's actually, after recovering off that low, which I thought was a pretty good sign, it's actually had a negative update and actually gone a bit lower here again. So it's actually stopped out the rest of my position here on that. But look, that's just trading there. Sometimes you sort of get it wrong here. So I still like this sector here. It'd be interesting to sort of see what happens with the stock here in the next week or two. I still think there's a pretty interesting sector to be looking at there. I still think that healthcare is, it's just a lot of these companies are sort of transitioning sort of from going through a period of sort of COVID where normal operations got impacted, which is sort of negative, but then COVID has given them a boost because of all the COVID testing and stuff there. So then they got to transition back to normal operations. And so, that might take a little bit to do there, but our market will look forward and stuff there. But yeah, it is a stock. I do like the sector here. Just this stock so far has probably been one of the weaker ones here. So, just be interesting to sort of watch this, just sort of maybe some sort of false break here again, but that's all right. But look, I mean, I think that Medibank Private actually, which is the next one there, that's pretty interesting as well. That's sort of, I think there's a sort of probably some sort of overreaction here. Obviously, data breach is not great, but company's sort of fallen, over 20%, or I think close to 25% from its high there to the recent low there, just on a data breach there. And then, I don't know, thinking about that logically, is much going to change at Medibank Private? I mean, a few of the sort of a few of the client, few clients might decide to go and use someone else because they've been a breach, but most people aren't going to give up their health insurance, and they're sort of still with COVID still lingering. And I doubt in the end that most people, you might only be a small part actually that move on here.
I read an analyst report on that on the day it happened, saying that it was down 18% on the day, and it was what they perceived as like you're saying, an overreaction to a one-off event. The movement in the market capitalization that day was a drop of $1.74 billion, which they, at the time, I know it's changed a little bit since the day, but that was 58 times more than the $30 million provisioning they'd had for the cyber attack.
Yeah.
So I think, like you're saying, 58 times the provisioning is a pretty big overreaction. And I don't know.
But how does it affect? I mean, at the end of the day, you got to look at how is it going to affect the business. Are you going to lose customers? Are you going to lose? Is a fine equivalent to that? I mean, that's probably company might get a small fine there, but the reality is here now is as people are saying with Optus, probably the safest place to be now is Optus, because they're going to have the most stringent, security there now, and Medibank Private is probably going to go the same way as well. So it'll probably be the safest place to be now, even though there has been a data leak there. But yeah, I just think at the end of the day, logically, what you might lose 2 or 3% might be annoyed enough to move, but that should be offset at sort of 20-25%. So I think it's probably overreaction now. I think it's still pretty good business. I think still with COVID still lingering, no one's really going to give up healthcare. Their private healthcare, I think, as well. And I know you've got some inflationary pressures there, so that's maybe that's an argument there. But it's sort of you find that sort of things like food and healthcare, they're generally the things that people don't give up. It's the other things that start giving up there. It's your weekends away or restaurants and holidays and stuff there, even though none of us have had those too much. So, but those are the things normally sort of people sort of give up here. So so I think this looks like a pretty good value point here. I think probably an overreaction. So I just think that'll sort of steadily sort of go back to 310. It could even go back and fill that gap there all the way back to 330, sort of around there as well. So I think this is a pretty safe stock to me.
Right. Well, you've got two more in this report. You've picked up SmartGroup Corporation. Now, they've had some pretty significant drops, a bit of impulsive movement in there, and then it looks like it's sort of slowed down in pace to whether that's rounding out a bottom. Don't know. How do you take that final movement as it's sort of flattening out?
Yeah, just saw that washout there on that big. It was basically 2 big days there. It sort of washed out the low, so where the market sort of at new lows there, and that's probably one of the. I think it was like the second heaviest and the third heaviest day of the year, volume wise, and then prices recovered, didn't sort of follow through there. So it's almost like your exhaustion of sort of sellers there, and that's a fairly decent move there. And there's been a lot of talk about. New sort of some leasing changes as well around sort of particularly around sort of cars and stuff there for around government and things like that. So
there's also new legislation about fringe benefit taxes and those kind of things.
So potentially some changes ahead there, which could be positive for in terms of basically getting. Because I think even Tesla has sort of got some cheaper cars there for. Which will be able to, as well. So I think some of the provisioning around some of these electric cars as well. So as part of the packaging there. So it's just
if it's plated July 2022 onwards, it can be exempt from fringe benefit taxes. So that was a real kicker in the recent budget announcement, which got a lot of automakers, if they're electric exposed, happy.
Yes, I mean, these things take a little time to come in there, but just a few positive changes in an industry which has probably been under a bit of pressure there. But just that washout of the chart looks pretty interesting. It looks like a little false break to me. But if it can sort of build here off that low, there might be, I think that MGH had a similar pattern there last week, and we've seen that pop this week here pretty strongly. So just thought I'd have a look at sort of, these false breaks or, so Wyckoff refers to them as these sort of spring lows, So
Well, you've
So
traded them exceptionally well, and those who've only joined recently, that was a staple of your portfolio before the COVID era. It was consistently trading that, the false breaks.
well, I just like
So,
them because if you're wrong here, Chris, you're risking very little, because if you buy close to the low, then you're only got a small amount of risk, and if you get a big move, then your reward's pretty large. So you only have to get a small percentage of these right to actually be profitable. So that's the attraction, is you will get some wrong, but if you get them right here and get some big moves there, you can make some pretty good dollars there, pretty good trades there.
I've definitely seen you put on trades where you're risking $1 to make 9. So
yeah,
it's a good proposition.
those are the ones you want. I mean, it was what's it? Paul Tudor Jones was, I think, his one of his sort of rules is 5-to-1 risk reward. So which is pretty. It's higher than most. So but yeah, he's got one of the highest yet. He does happen to have one of the best trading records. So maybe there's something in that. So yeah, but the other one there, it was actually, I've been looking at property. I think you mentioned it actually a week or two, that the property stocks were doing pretty well. But I think we featured one last week of property trusts, and then just noticed a few of the property trusts have actually been breaking out of sort of like downward channels and stuff there. So definitely a lot of stocks looking pretty good in there. So GMG is sort of one that I've traded, and GPT, I think, has broken out of a channel as well. And just quite a few of them actually looking reasonably positive. So I just noticed here that Dexus, this is a pretty decent downtrend here. But the last month or two here, we're really on sideways and a bit of a channel there. And then we did sort of, have that big volume day, went to a marginal new low, almost exhaustion of sellers again on that massive spike there, and that's our low, and it hasn't followed through since then. Now we're starting to build, and the volume has been elevated as well. So that's sort of telling us here. So everyone says staying away from property. No one's going back to the city. Interest rates are going higher. Why would you be long property or these services here? But you got to think the market looks ahead here. It's already had a massive decline here already. So the one thing was sort of, the research I did on the 70s was that although inflation was 7% on average over the decade, the property prices went up, I think 9.5% over the decade each year. So obviously they do better in low inflation environments, but still being a long asset still do quite well. So you've just got inflationary pressures as well. So it's, you've got a bit of a double whammy there. You've sort of got one working for you, one working against you, but you still got to be long assets there in those high inflationary periods. So but just your price action is painting a reasonably positive picture, and surprisingly, that sector is actually showing some relative strength there. So probably at a point where the consensus view would be not to go near that sector, which is oftentimes the time to be looking at it, as we know. So yeah, but
there's been a lot of talk about the revamp of the GFC when the property sector was overgeared, short-term debt, and exactly what you're saying. It was just the place not to be. But also, like you're saying, the market's starting to look through that and realize most of these property trusts have de-geared, delevered significantly. Those boards do not want to revisit the past, and now there's new directors' obligations in place. They don't want their own houses at risk. And their debt covenants are much more robust, especially with the inflation expectations and the yield curve the way that it is. They're able to secure longer-term debt lower than the current short-term debt. So most investors that dumped these were using short-term debt models. But that's an aside. We come back to the bigger picture. And like you said, you pick these up.
Yeah, I think the other thing too, Chris, there is that if everyone's sort of saying don't go near it, then that usually tells you that everyone's sold out of that sector. So pretty much, it's as we sort of discussed on a few of these sort of chats here, is that if everyone's saying it's a sell, then that they've usually all sold. So there's usually no one. That's usually the point where there's no one left to sell, because they're all out. So when everyone's already all out of the sector, it's usually when the sector can sort of finally sort of climb up here. So start climbing the wall of worry, as they say, when all the sellers have done.
they're all underweight and starts to outperform, they need to scramble back.
Yeah.
Well, that's a good way to look at the market. And like you've said, the property issue picked up in the 30/30 report. There were a fair few constituents in there that were from the property space. I think you and I looked off air at one of the reports during the week that 5 of the 6 top launchpad themes were property related. And like you've seen here, they've had a bit of a pop after that. So that's probably a good plug for what we'll put on the right-hand side there is that playlist of the Friday reports that you go through and talk about the leading themes, the leading shares, the pros and cons of the chart, and then also this weekly playlist. And then on the left-hand side, your Twitter handle, if people want to follow you and get in contact. Is that a good thing for us to wrap on, Gary?
Yeah, perfect.
Nice. Well, thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.